Welcome to the 1715 Treasure Coast Financial Wellness Podcast. I'm Thomas Davies, your fee-only fiduciary wealth advisor here on Florida's Treasure Coast in Stuart, Florida. And today we're tackling a topic that I deal with constantly, and I mean constantly, in my practice. If you've moved to Florida, or you're thinking about moving to Florida, to escape high state income taxes, this episode might be the most important thing you listen to all year. Because here's the truth that a lot of people don't want to hear. Simply living in Florida is not enough to satisfy your old state's tax auditor. Not even close. I'm going to walk you through exactly what states like New York, New Jersey, Connecticut, Massachusetts, California, Illinois, and others are actually looking for when they come knocking. And trust me, they do come knocking. I'm also going to give you a clear roadmap for making your Florida domicile absolutely bulletproof. We're going to cover residency requirements, property tax implications, healthcare considerations, what this means for your investment portfolio, and some critical estate planning updates that most people completely overlook. So let's dive right in. Now let me set the stage here. Every year, thousands of people move to Florida. And one of the biggest draws, let's be honest, is the fact that Florida has no state income tax. Zero. And when you're coming from a state like New York, where the combined state and city tax rate can push north of 12 or 13%, or California, where the top rate is over 13%, we're talking about potentially saving tens of thousands, even hundreds of thousands of dollars a year, depending on your income level. That is a massive incentive. But here's where people get into trouble. They buy a home in Florida. They start spending winters here. They tell their friends, "Oh, I'm a Florida resident now." Maybe they even get a Florida driver's license, and they think that's enough. They think the box is checked. And then 18 months later, they get an audit notice from their old state saying, "We don't think you actually left. You owe us back taxes, penalties, and interest." And I've seen this play out more times than I can count. So why does this happen? Well, it happens because high-tax states are losing billions of dollars in tax revenue as residents leave for places like Florida, Texas, Tennessee, and other no-income tax states. And they are not just going to wave goodbye and wish you well. They have entire audit divisions dedicated to challenging residency changes. New York, for example, has one of the most aggressive audit programs in the country, specifically targeting people who claim to have moved to Florida. They call them Snowbird audits, and they are thorough, invasive, and incredibly detailed. Now let me explain what your old state is actually looking for, because this is where the rubber meets the road. Most high-tax states use what's called a multi-factor test to determine your domicile. Domicile, by the way, is different from residency. Residency is about where you physically are. Domicile is about where you intend to make your permanent home. It's where you have the deepest ties, the strongest connections. And your old state wants to prove that despite what you claim, your domicile never really changed, that Florida is just a vacation spot and your real life is still back in your old state. So what are the factors? Let me walk through the big ones. First, and this is probably the most important one, is the day count. Most states, including New York, have what's called the 183-day rule. If you spend more than 183 days in a tax year in that state, you can be considered a statutory resident, regardless of where you claim your domicile is. So right off the bat, you need to be tracking your days meticulously. And I don't mean roughly or approximately. I mean precisely. Every single day. Where did you wake up? Where did you sleep? If you spent any part of a day in your old state, many auditors will count that as a full day. So if you fly into New York at 11 p.m. and leave the next morning at 6 a.m., that could count as 2 days, not one. My advice? Keep a contemporaneous log. Use your calendar. Save travel receipts. Keep credit card statements that show where you were making purchases. Easy pass records, cell phone records showing which towers your phone was pinging off of. I know this sounds extreme, but when you're sitting across from a state auditor, this is exactly the kind of documentation that wins the case. Now here's the thing. Even if you pass the 183-day test, meaning you spent fewer than 183 days in your old state, they can still come after you on domicile grounds. The day count is necessary, but it is not sufficient. You also need to demonstrate that your domicile has genuinely shifted to Florida. And this brings us to the second major factor, which is your primary residence. Where is your primary home? And this isn't just about where you own property. Auditors look at the relative size, value, and nature of your homes. If you have a 5,000 square foot home in Connecticut and a small condo in Florida, that's a red flag. The auditor is going to say your real home is still in Connecticut. Ideally, your Florida home should be your larger, more significant residence. It should feel like and function as your primary home. Your furniture, your personal belongings, your family photos, your valuables, they should be here in Florida. And this connects directly to property taxes, which is our next big topic. When you establish Florida as your primary residence, you become eligible for what's called the homestead exemption. This is a really valuable benefit. In Florida, the homestead exemption reduces the assessed value of your primary residence by up to $50,000 for property tax purposes. It also provides significant asset protection, which we'll talk about in a moment when we get to estate planning. But here's what's important from a domicile perspective. Applying for and receiving the Florida homestead exemption is one of the strongest signals you can send that you've committed to Florida as your permanent home. Conversely, if you're still claiming a primary residence property tax benefit in your old state, that's a major problem. You cannot be claiming primary residence status in two states simultaneously. That's a red flag that auditors are specifically trained to look for, and frankly, it could create legal issues beyond just the tax audit. So if you haven't already, make sure you've filed for homestead exemption in Florida and relinquished any equivalent benefit in your old state. And by the way, there are some significant property tax differences to be aware of between states. Many northeastern states have considerably higher property tax rates than Florida, so this move can produce savings on multiple fronts. But the strategic point here is about establishing clear, unambiguous evidence of where your primary home is. Now, let me move on to the third factor, and this one trips people up more than you'd expect. It's about where your near and dear items are. Auditors want to know where your most cherished personal possessions are located. Your family heirlooms, your art collection, your jewelry, your pets. Yes, your pets. If your dog's veterinarian is still in New York, that's a data point the auditor will note. Where are your important documents kept? Where is your safe deposit box? All of these things paint a picture, and the auditor is looking at the totality of that picture. The fourth factor is your business and professional ties. If you're still actively working in your old state, commuting back for business regularly, maintaining an office there, that significantly undermines your Florida domicile claim. Now, I understand that many people can't cut all business ties overnight, but you need to be intentional about shifting your professional life to Florida as much as possible. If you're on boards of directors, are those boards in your old state or in Florida? Where are your professional affiliations? Where do you attend conferences and industry events? Fifth, and this is a big one, is your social and community ties. Where do you worship? Where are you a member of clubs and organizations? Where do you volunteer? Where do your closest friends live? If your entire social life is still centered in your old state and you haven't put down any roots in Florida, that weakens your position considerably. So get involved here. Join a club, attend a house of worship, volunteer with a local organization. These aren't just nice things to do for your personal fulfillment, though they certainly are that. They're also building your domicile case. Sixth is your family connections. Where does your spouse spend most of their time? Where do your children go to school? If you have dependents, where is their primary residence? A common scenario I see is one spouse moves to Florida while the other stays behind in the old state, maybe because of work or because the kids are still in school. This is a very difficult situation from a domicile perspective, and it requires very careful planning. And then there are what I call the administrative markers. These are the things you can control immediately and should address right away. Get your Florida driver's license, register your vehicles in Florida, register to vote in Florida, and actually vote here. Use your Florida address on your federal tax return. Update your address with your bank, your brokerage accounts, your insurance companies, your subscriptions, everything. file a declaration of domicile with the county clerk here in Florida. This is a formal legal document stating your intent to make Florida your permanent home. It's not conclusive evidence on its own, but it's an important piece of the puzzle. Now let me shift gears and talk about something that often gets overlooked in the excitement of a move to Florida, and that's healthcare. Specifically, Medicare and healthcare coverage changes across state lines. If you're on Medicare, the good news is that Medicare is a federal program, so your basic coverage travels with you no matter which state you're in. However, and this is a significant however, if you have a Medicare Advantage plan or a Medigap supplemental policy, those plans are often state-specific or region-specific. When you change your permanent residence to Florida, you may need to enroll in a new plan that covers providers in this area. The same goes for any marketplace health insurance plans if you're not yet Medicare eligible. I've seen situations where people move to Florida, have a medical event, and then discover that their insurance coverage is tied to their old state's network. That can create real problems, both medically and financially. So when you're planning your move, put healthcare transitions on your checklist. Review your coverage. Contact your insurance providers. Understand what changes when your official residence changes. And make sure you have providers lined up here in Florida before you need them, not after. This is especially important for pre-retirees who might be on COBRA or a spouse's employer plan. The logistics of healthcare coverage during a state change can be more complex than people anticipate, and it's something I always encourage clients to think through carefully. Now let me talk about something that's right in my wheelhouse, and that's the investment portfolio implications of a state change. When you move from a high-tax state to Florida, the tax landscape for your investments changes meaningfully, and this creates both opportunities and considerations that you need to be aware of. First, let's talk about the opportunity. If you've been holding investments with large unrealized capital gains and you've been reluctant to sell because of the state tax hit, Florida changes that equation. Once you're a bona fide Florida resident, there is no state income tax on those capital gains. That can create a window to rebalance your portfolio, to take gains you've been sitting on, to diversify concentrated positions, all without the state tax drag that would have applied in your old state. But, and this is really important, the timing matters. If you sell those positions before your domicile change is fully established, your old state may claim those gains are taxable. So this requires careful planning and coordination between your financial advisor and your tax professional. You don't want to be in a situation where you sold $1 million in appreciated stock, thought you were a Florida resident, and then your old state says, actually, we think you were still domiciled here, and you owe us $100,000 in state taxes on that gain. That's a nightmare scenario, and it's entirely avoidable with proper planning. Second, think about your municipal bond holdings. If you've been holding municipal bonds from your old state because they were tax exempt in that state, you may want to reconsider that allocation. In Florida, where there's no state income tax, the state tax exemption of those bonds is irrelevant. You might be able to find better opportunities in bonds from other states or in other fixed income instruments that offer better yields or better credit quality. Third, if you have stock options or deferred compensation from an employer in your old state, be very careful. Many states have specific rules about taxing deferred income based on where it was earned, not where you live when you receive it. So even after you've moved to Florida, your old state may have a legitimate claim to tax a portion of that income. This is an area where you absolutely need professional guidance specific to your situation. And fourth, consider the impact on your overall tax planning strategy. In a high-tax state, certain strategies like maximizing pre-tax retirement contributions, using tax loss harvesting aggressively, and favoring tax-exempt bonds made a lot of sense because the state tax savings amplified the benefit. In Florida, the calculus may shift. Maybe Roth conversions become more attractive because you're not paying state tax on the converted amount. Maybe your asset location strategy between taxable and tax-advantaged accounts should be reconsidered. The point is, a state change should trigger a comprehensive review of your investment and tax strategy, not just a change of address. Now let me turn to what I consider one of the most critical and most frequently neglected aspects of estate change, and that is estate planning. When you change your domicile, you need to review and likely update your estate planning documents. And I don't just mean having a lawyer look at them. I mean a thorough review in the context of Florida law. Here's why this matters so much. Different states have different rules governing wills, trusts, powers of attorney, healthcare directives, and other estate planning instruments. A document that was perfectly valid in New York might have issues in Florida, or it might not take advantage of Florida-specific benefits. For example, Florida has one of the most generous homestead protections in the country. Your primary residence in Florida has significant protections from creditors, and there are specific rules about how homestead property passes at death. But those protections come with restrictions too. For instance, if you're married, you generally cannot leave your homestead property to someone other than your spouse, even in a will. If your estate plan was drafted in another state and doesn't account for Florida's homestead rules, you could have unintended consequences. Similarly, Florida has its own rules about the validity of out-of-state powers of attorney. While Florida will generally honor a power of attorney executed in another state, there can be practical difficulties. Financial institutions in Florida may be more comfortable with a Florida-specific power of attorney, and having one can avoid unnecessary delays and complications when you need to use it. And here's a really big one that catches a lot of people off guard. Many states, including New York, Massachusetts, and others, have their own state-level estate or inheritance taxes with exemption thresholds that are much lower than the federal exemption. The federal estate tax exemption is quite high right now, but some states start taxing estates at much lower levels. When you change your domicile to Florida, which has no state estate tax, you could potentially save your heirs a very significant amount of money, but only if your domicile change is bulletproof. If your old state successfully argues that you were still domiciled there at the time of your death, your estate could face a substantial state estate tax bill that could have been avoided. So the stakes of getting domicile right aren't just about income taxes during your lifetime. They're about estate taxes at your death. And for high net worth individuals, the estate tax savings of being a Florida resident can dwarf the income tax savings. I want to be clear about something. I can't give you specific tax or legal advice in a podcast. Every person's situation is different, and the rules are complex and constantly evolving. What I can tell you is that this area demands professional attention. You need a team that includes a qualified tax professional, an estate planning attorney licensed in Florida, and a financial advisor who understands the interplay between all of these issues. That's the kind of comprehensive approach that we believe in. Now let me bring this all together with what I think of as the domicile defense checklist. If you're making the move to Florida, or if you've already made the move and you're not sure you've covered all your bases, here's what you should be thinking about. Number 1, track your days. Keep a detailed, contemporaneous record of where you are every single day. Use your calendar, your credit card statements, your travel records. Make sure you're spending fewer than 183 days in your old state. Number 2, make Florida your primary home. Your Florida residence should be your larger, more significant home. Move your personal belongings here. Apply for the homestead exemption. Relinquish any primary residence benefits in your old state. Number 3, update all your administrative records. Driver's license, vehicle registration, voter registration, mailing address, bank accounts, brokerage accounts, insurance policies, professional licenses. Everything should reflect your Florida address. Number 4, file a declaration of domicile with your Florida county clerk. Number 5, shift your social, professional, and community ties to Florida. Join organizations. Find doctors, dentists, accountants, and attorneys here. Get involved in your community. Number 6, review your healthcare coverage and make sure it works in Florida. Number 7, have your investment portfolio reviewed in light of the state tax change. Look for opportunities to rebalance, diversify, and optimize your tax strategy. Number 8, update your estate plan with a Florida attorney. Make sure your will, trusts, powers of attorney, and healthcare directives are all current, valid, and optimized for Florida law. Number 9, and I cannot stress this enough, work with professionals who understand the nuances of state tax residency and domicile issues. This is not a do-it-yourself project. And number 10, be consistent. The worst thing you can do is send mixed signals. If you say you're a Florida resident, but your actions suggest otherwise, you're inviting an audit. Everything you do should be consistent with the story that Florida is your permanent home. Now, I know this might sound overwhelming, and honestly, the first time I walk a client through all of this, they often look a little wide-eyed. But here's the thing. None of this is impossibly complicated. It just requires intentionality and organization. You need to approach this move with the same level of seriousness and planning that you'd give to any other major financial decision. Because the stakes are real. We're potentially talking about hundreds of thousands of dollars in state income taxes, plus estate taxes, plus penalties and interest if your old state successfully challenges your move. That is not an abstract risk. It happens to real people every year. But on the flip side, when you do this right, when you make the move properly and establish your Florida domicile with all the right documentation and all the right steps, the financial benefits can be tremendous. No state income tax on your earnings, your investment gains, your retirement income. No state estate tax for your heirs. A favorable property tax environment. Strong asset protection. There's a reason Florida is one of the most popular destinations for retirees and high-income individuals, and it's not just the weather. So if you're thinking about making the move, do it right. And if you've already made the move but you're not sure you've checked all the boxes, it's not too late to shore things up. The best time to get your domicile in order was when you first moved here. The second best time is right now. As always, everything I've shared today is for educational purposes only. This is not specific investment advice or tax advice or legal advice. Your situation is unique, and you should work with qualified professionals to address your specific circumstances. We are a fee-only fiduciary registered investment advisory firm, which means we always act in our clients' best interests. If you want to learn more about how we help clients navigate these kinds of complex financial planning issues, you can find us at tdwealth.net. Thanks for listening to the 1715 Treasure Coast Financial Wellness Podcast. If you found this helpful, subscribe wherever you get your podcasts. I'm Thomas Davies, fee-only fiduciary advisor here on Florida's Treasure Coast, and I'll see you next episode.